Hey guys, this is Julie. So this is my proprietary indicator. It is not standard deviation. I use a statistical model to, calculate volatility like every other hedge fund does. And my model, um, I measure from the mean to the three. So I'm only using half the distribution. So mean to, or three to three would be one time the distribution fully. So I'm using half of it, 0.5 times. So when you go from my three, mean to three, one time fully, it's actually 1.5 of the distribution if you were taking the whole distribution. And if you go from, excuse me, add another one time the mean to three, that's when you would get to two times the fib on the Jats indicator. Um, and that represents uh, for the entire distribution from three to three, um, one complete time. So I'll show you that real quick. So if you measure from three to three, and then copy and paste it above, you'll see you get to the same level one time. So it's one full time out or two times the distribution. And so we can measure the ranges, uh, equidistance on the tails to what they are inside the distribution. You're not restricted to, measuring equidistances like that, but this works out really well, and it's how the algos trade a lot of the time. But if you wanted to get a replication of, a Fibonacci number, you could do that also. So you could just change it to the fib levels or statistical levels 34, 68, 95. You could carry that out also. And, they make interesting fibs. No doubt about it, you can play with those. But for our purposes of explaining the framework right now, just realize we have points and levels. So the points are the Jats oscillator on the bottom, and you can map any time frame you want. This is on a daily bar, so I've got a daily 14 period range right here, which is what the standard range is for most of your indicators, RSI, statistics, ATR, CCI, everything. Basically, your world revolves around that 14 period range. You can measure, your volatility on a 20 period though if you would like, or 5 period or 7 period. You can make that adjustment. Um, so you can change how the volatility is represented. A one period, like I've shown with the yellow line, is interesting because that allows us to get the R vol. Where are you? Where's my one period? There it is. So you can run it on top of a 14 period distribution. Just lay it right on top. And that tells you what the actual point range of the market is from high to low in a point range, and whether it's inside the distribution or outside. And this is really key because if it's inside the distribution, then you don't have to be buying tails outside. Do you see what I'm saying? You can rely, depending upon where it is. This is showing it's between the 2 and the 3, and you can see here that we're between 2 and the 3. So it's showing you on a point range what the points actually are, 104 points to 120 points, and where those levels are that the market will trade to. Okay? Points and levels. All right? So it's something that you can actually understand. If it is outside the R vol is outside the H vol, the Jats H vol, R vol, historical volatility, realized volatility. I mean, these labels are not trademarked or anything. It's just Jats proprietary version of it. I'm not using their calcs. Um, so we would be able to be trading to those outside levels. Anytime you get outside the distribution, you are going to be wanting to look for those one and a half, one and a quarter, two times the range excursions. And that's when you would want to come in with your, call spreads or put spreads, depending upon the direction that you're trading. And or if you're inside the distribution, you can be selling your condors, right? So anytime you're down in here, you know that it's going to stay inside these white ones. Kind of hard to see, but you get the point if you know if you've been trading any period of time. And you can do this on all contracts on all time periods, right? It's not just daily. It works the same on monthly, quarterly, 60-minute, 1 hour IB, Globex. You see how far outside the range the real volatility got. You see how deep it went right to our confluence of the solid shows me that it's on the open, dash shows me that it's on the close of the session, and my color coding 1.25 is the tan, yellow's 1.5, red is, well, I've got two reds on here, that's a mistake. Or wait, two tans. I need to make that other one green. I haven't gotten all my charts fixed. But 1.25, 1.5, 1.75, and two times outside the three, going mean to three. But it gives you concrete point levels to look for with your options. So I can pull up my options chain. I use Quick Strike. I can show you how to set up your quick sheet. And I'm using premium change, put premium, strike, call premium change. So I know right here where the implied volatility is by my premium, and whether it's moving, up the calls or down the puts. Um, and you can, trade your framework. Um, I can see here that overall for the day, there is 37 points put premium, 37 points call premium at my 56.40 strike. That was the close. So 37 and 37, added totally together, um, which is, of course, your 74-point implied volatility range for the day. So that's what they're assuming the market is going to be trading for Monday, be the 74 points of implied vol. I can look here and see that my R vol or my H vol was way elevated at 120. So 74 is even below the PT2 of that point range, right? So I'm going to be anticipating a low range day compared to last week, back below the daily 2, my 68% of the range, which is currently priced at 86.25. So my daily 2 range at 86.25 is even above their entire day 74 point range that they're expecting priced in for implied vol. So how we know whether this range is going to, stay the same or contract or expand, because and I know volatility does not stay the same, right? It moves throughout the day. And our gamma levels will tell us whether the dealer is overall, you know, positive or negative on the GEX, where those high gamma strikes are, because the market likes to go to the high gamma and sell it because they make more money. we can see where our theta is. Our high theta is going to be around that high gamma. And so we can see where their pinning is likely to be um, at at any time it, with this open interest also. So we can see here where my open interest is on this right side. I've got call open interest and put open interest. And so I can see where my high strikes are. Here's one with 8,000 on it. 5,700. That's going to be well defended. But even closer, here's this 2,037 um, open interest that are all calls. So there's your call wall, and your call wall sitting at 5,650 where the high was. So you can look up this put chain and see the next put level is at 5,600. But if we were to take that 74 or you know um, premium that we're expecting for the daily range and subtract it from the premium that we're closed at 1851, right? So if you take 74 and minus your 1851, and I know you market makers are laughing at me because you could do this in your head. You've got 55 premium that you're going to be trading to, right? So you look at your premium over here and you see your call premium at 55 is sitting at 55.90, or your put premium for 55, is sitting somewhere around 56.90, 56.85. So I doubt we'll get past this high open interest over here. So you would be looking more in line to hitting your open interest to the put side, potentially. You know, if you calculate that that's your total premium and you're already at 1851, you would subtract it to get to the balance of where you would need to trade to. So you would maybe want to look at where the 74 is in relation to that 55, and there is your spread. You getting goosebumps? All right, I told you you're going to like this. So quick strike together with Jats PT and seeing where we are in the implied vol HVol world, and then being able to come in here on a daily and hourly basis or a Globex basis, for overnight. I guess we're going to do an RTH session, but you can see where your threes all line up, and we were at the end of our daily range Friday. But we can take our framework, our daily framework, and see that if we want to go 86.25 above the current close or below the current close at 56.28. Sorry, here. 56.28.75 minus my 86.25 would be 55.42. So I would be putting a horizontal line at 55.42, thinking that's going to be I want to make that blue because it's my PT2 level. Cayenne. I think that's what I use. So here is my put. All right. And I'll come in on my option chain and see where 55.42 is. And we'll be doing this Monday. Um, here. So this is at more or less their 100% of their range. All right, on their call premium for your put. 74. So 74% of that range. And we were using the put premium, so it's 74%. So that would be, where you might want to put that out of the money put, right? 55.40, perhaps, because that's outside. Well, that's sitting on your expected range of 74. So you might want to go just to, one out or two out, two strikes out. We'll take a look at that. But here is, my overall framework, and then we would want to come back and sorry, we didn't mean to let that go. Hang on 1 second. Take a look at the gamma, and so you can see that the gamma is low, which often will signify a dealer pinning. It's that's something that they're not as likely to hedge, so it could pin to the level. You see what I'm saying? If it had higher gamma on it, it would be more volatile and push price away from it. And so that is more of a sticky low gamma, just to do an off the cuff analysis of it. And your open interest is low, so the open interest in front of it is 55.50. That's a big even number. And so, that will give you some support in front of your level. So you're behind the 55.50 high put open interest. And I like that position. So positionally, it looks pretty good too. And the real high open interest is here at our 55.75. And so that could, be your first line of defense to slow people down if it did get to the second level, which would slow them down even more, and you should be safe with that out of the money at the end of the session. That's, the thought. That is the thought behind trading what the implied volatility point range is expected inside the current R-vol, H-vol landscape, and then using our Jats levels to cement, the location positionally of where you would want to place those options, considering, your landscape for it. And know whether to trade, call spreads or put spreads if you think it's going to be a range expansion day. If we had, like high gamma on that strike, then we'd be pushing for those range expansions. You see what I'm saying? So we can, use our Greeks and our quick strike, open interest volume and Greeks to figure out, how that market maker might hedge these places. But so what we've discovered today with this framework is that we can use R vol, H vol inside around these. It's a true distribution for the realized volatility inside the land of the implied volatility that you've all been living in. So it makes a more complete system, and it can track how market makers play the distributions in real time and pinpoint these inflection zones with precision rather than guessing at where the pivots of where the support resistance might be. I mean, you can just open your eyes and see that the market is attracted to these levels, and that will help you learn how to trade to them or place your risk away from them so that you're always out of the money if you like selling premium. Okay. And then having a map of how that volatility plays throughout the day. I mean, if you're, trading condors or trading call or put spreads, and that intraday, 1 hour volatility inside a daily volatility can really help you see when the vol is going to be, staying inside the range or when you're going to be breaking out. And then it can be trading to these, you know, range levels. Like here's the 1 hour IB range level on a 60-minute bar. Doesn't that make sense? It went to the 1 hour IB2 or the 1 hour IB3 and then comes back in. So we'll be talking about, 1 hour IB, daily ranges, and then taking advantage of where we are positionally inside these ranges with the overall framework of how we're going to approach the day using the R vol, H vol, and IV vol with Greeks. And that's pretty much it. It's basically what we've already done, except for we're looking at it through the lens of 0 DTE as well. I mean, I've got VIX and SPX doing the exact same thing. Let me show you that. Oops, where did my SPX go? Hang on. Okay, here it is. So we can do everything with the VIX and the SPX the same. We can show, hourly ranges and daily. So over here in this column where the yellow bars against the lines, um, this is depicting let me get these horizontal lines out of here. These were just benchmarks. Okay. So here you can see that the one realized volatility is inside the 14 historical volatility, right? Inside the SPX was inside even at the daily 2, and then the VIX broke the daily 2 and was heading to that daily 3 just like the ES was showing. So SPX was constrained below the ES, and so cash was falling behind futures. So futures were being priced in with more volatility than the cash index was. So that helps you in itself on a daily time frame. And then we will do intraday time frames as well to show you 15-minute or how to trade inside, a 60-minute range. But these lower time frame ranges that we like to trade in as day traders or 0 DTE traders and help you time your trade. Whether if you're going to be trading, right off the bat, a like I said, call spread, put spread, or wait for to sell your condor premium day. All right, this needs to be reset off the daily. This one too. Hang on. If you untoggle, a choice to set the date, the data distribution period, it will grab whatever the chart default. It'll default to the chart time frame. So I like to do that. So here is the 15-minute. And if you would like to do a 60-minute, you can just change it. So here is the 60-minute, 24-hour, 60-minute, and then you can add that first hour of trading to it by adding the new distribution, assigning it 8:30 to 9:30, put it on that panel 2 on top of it. You can just lay it right on top. Same panel as the others. And it will, because it's the same thresholds and everything, it'll just give you the 1 hour IB range as well. Did I not get that? Hang on. Okay, so here is a 15-minute range, 15-minute bar, and we've got this. Let me change this to a 60-minute bar. So you can change this to a 60-minute range for, just 24/7 data, or the range specifically between 8:30 and 9:30 over the last 14 trade sessions. And so you can see that the 15-minute data trades, if you're below the 60-minute 2, you're going to be little tiny bars inside the 60-minute 2. If you are above the 60-minute 2 or 3, you know, you're breaking out to those higher levels. So this really, really, really helps you plan, whether to send your out of the money puts and calls out further, roll them, or just close and go to a put spread, call spread. I'll go back over there and we'll take a look at this. Right here, and you can see that it broke out of the ones and went down. Kind of got pinned here at this 1.25 outside the distribution. See how they come in automatically to pin it on these levels. This is actual volatility in the market, and you can see that they go routinely to these outside excursion levels. 1.75 times the open daily range on the open. That was a big one. And you can see that the your range is extended, and here we broke out of the 3 and it really exploded up. So this is, I hope a very helpful framework for you, and something that you'll like having on your chart, or having access to in the live stream. All right, thank you so much. Let me know if you have any questions, and we'll look forward to getting this started Monday and walk forward testing, coming up with our game plans, and getting that information out to you um, each day. Thank you so much.